Most day traders overtrade. They open 30 positions a day, dilute their edge across mediocre setups, pay transaction costs on every trade, and end the month wondering why a strategy with 60% paper win rate produced a losing P&L. The cause isn't the strategy. The cause is frequency. Trading more often produces fewer A-quality setups per session and more B-quality noise. Costs scale linearly with trade count, edge does not. Today, the frequency versus quality trade-off, why 2 great setups per day beats 20 mediocre ones, and the A setup filter that fixes the problem in one rule. Here's the math nobody shows you. Your edge is concentrated in a small number of A-quality setups, the ones where multiple confluence factors align. B setups, where 1 or 2 factors fire but the rest are weak, are near break even at best after transaction costs. C setups are negative expectancy. Most retail traders take all 3 categories because they're bored, fear missing moves, or want to feel productive. Result, the A setups earn their edge, the B setups give it back to commissions and slippage, the C setups cost money outright. Net P&L is negative even though the A edge is real. Watch this in a synthetic equity curve. A trader takes every signal that fires on their indicators, 20 trades a day, all flavors. The equity curve grinds sideways, drifting slightly negative over a month despite a real edge on the best setups. Their A setups were profitable. Their B setups were break-even. Their C setups bled them out. The aggregate looks like the strategy doesn't work. The strategy works fine. The trader's filter is too loose. They're confusing activity for progress. Here's the fix in one rule. Demand 3 or more confluence factors on every trade. Trend agrees, level holds, momentum confirms, volume expands. If 3 of those 4 don't align, skip the trade. The result, trade frequency drops to 2 to 4 setups per day instead of 20. Quality of each trade goes way up. Transaction costs collapse. The A setups now drive the whole P&L instead of carrying dead weight. The same trader, same strategy, dramatically different P&L, driven entirely by what they didn't trade. Now with the A setup filter, the trader passes on 18 of 20 signals. They don't meet the 3-factor minimum. They take the 2 that do. Both are profitable. One is a multi-hour winner. The equity curve climbs steadily because the A trades aren't being dragged down by B trade noise. Lower stress, lower transaction costs, higher expectancy. The same skill applied with stricter filtering. This is the workflow profitable day traders actually use. They're famous for sitting still most of the day, then striking on the few setups that meet their criteria. In real practice, grade every potential entry on the 4-factor scale before clicking. Write A, B, or C in your trading journal next to the setup. Only take A-grade entries. The discipline is harder than it sounds. Most traders need to skip 10 setups in a row before they trust the system. But after a month of A-only trading, the equity curve speaks for itself. Boredom is the test the filter forces on you. Passing it is the edge. So, most day traders overtrade because they confuse activity with progress. Frequency dilutes edge, transaction costs scale linearly, B setups carry dead weight. Filter to 3 or more confluence factors only, usually 2 to 4 trades per day instead of 20. Same strategy, dramatically better P&L, subscribe for the full method and trade your own plan. Education, not financial advice.